Hello and welcome back to another episode of On the Brink with Castle Island. I'm Nick Carter. Today on the show we have Patrick Dugan. Patrick is the founder of Tradelayer, which is a protocol designed to bring financial expressiveness to Bitcoin and Litecoin. So when I started this crypto-dollarization series, it didn't really occur to me to look into who had coined the phrase. And I knew I hadn't coined it, but I wasn't sure who had. So I looked into it, and as far as I can tell, the first mention of crypto-dollarization came from Patrick Dugan in 2018. So Patrick wrote this great essay called HyperCryptoDollarization, which is a play on hyper-Bitcoinization, saying, the most interesting phenomenon in this industry is actually going to be the ability for public blockchains to carry dollars with potentially really significant geopolitical consequences. So I wanted to get Patrick on the show to talk about how he had this insight long before anybody else realized that it would be the case. He's also had a front row seat to a whole bunch of early stablecoin experiments. He was around when Tether was just getting started. And so he's kind of an amateur historian of sorts for some of these stablecoin projects. So I wanted to talk about that. And I also wanted to get his take on the current stablecoins. He brings a wealth of knowledge from derivatives trading and from having lived through capital controls in Latin America, in Chile and Argentina. But mostly I wanted to talk about how he realized that crypto-dollarization was an important trend here. So without further ado, let's jump right into the show.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin. Bitcoin.
Today we welcome Patrick Dugan onto the podcast. So Patrick is the founder of Tradelayer. He has managed dollarized Bitcoin treasuries, and he's traded derivative spreads for 6 years. On top of all that, according to my research, Patrick is the first person to have uttered the phrase crypto-dollarization. So I'm informally going to credit Patrick with coining that phrase. So Patrick, welcome to the show.
Well, thank you very much for having me, and thanks for giving me that credit. It really means a lot to me.
Well, you were, to your credit, you were talking about it, long before anybody else caught on to the idea, as far as I can tell. Although maybe they called it something else, but I think crypto-dollarization is the right word for it. So,
yeah, well, I adapted it in sort of late 18 and 19 when I was talking with more Bitcoin maximalist people to Bitcoin dollarization, so it would be palatable to them. But certainly Ethereum, got out in the lead. Although dollar for dollar, I mean, let's abstract out Tether. Let's just look at the Bitcoin swap market open interest. It is bigger than DAI, for example, right? And similar things on it. So actually maybe Bitcoin still has the network effect lead there. But these numbers are, in the retrospect, these numbers, this was a few $100 million, this was N billion. Nobody's going to care about what $1 or $2 billion was, because we're going to trillions, even if the money supply doesn't go crazy. Just from the time value. So we'll get to that. That's the big theme. And yeah, I think the reason why I am this dude, and I've been like a prophet in the wilderness for these 6 years about this trend and this use case. And a lot of Bitcoiners were just all about their gains basically, and I'll pay it with the credit card and whatever. And that's cool. And then I happened to be more sympathetic to the big blocker side of the Civil War. So then I had to reassess, and I came back to the other side. And so I think I've cleaned my record of that. But going way back further, going back to 2013 when I got into Bitcoin, the first trade I did, other than selling the Bitcoin for pesos in a capital controls country where I'd been robbed at gunpoint, right? That's my like origin story. My next trade really was an ARB that I did for a client who was another guy in startup Chile, and I made like $100, right? And I was like, holy shit, that's so much easier to make money on than delivering organic food, which is what I was doing at the time. So because I have such a weird life where I was like flying into Argentina to like deliver cash to people, you know, and all this stuff. And then later I was living in Argentina the next year under the capital controls. And I would have to go to a guy named Dante. And then there was like another guy. There were like 2 or 3 people that I would hit up to get money. And before that, I used Hawala, which I talk about in that blog post, the crypto-dollarization blog post, and how that worked, and how Bitcoin is like a much faster settlement, essentially, right? Whereas I had to trust the shadow banker to show up like a week later and deliver me all the pesos. So it's weird, you know, instead of like I get a direct deposit and my auto bill comes in and I pay my credit cards and I pay my cable and so on. God forbid if you pay for cable, but you know what I mean. I would have to physically like run around Buenos Aires like once a month and spend all these hours just settling my monthly billing cycle, you know, in cash, going through selling for Bitcoin to dollars and then selling dollars for pesos. And it was a really weird time. And then I moved to Chile, which has a very, so in Argentina, they would have this weird sort of harmony with the socialist spending of the government, where there was an official rate, which you'd get at the ATM. So you're getting super ripped off. And then there was the gray rate where people would buy bonds in New York and sell them in local currency. And it was all legal. And that would be a price sort of in the middle. And then on the high end, if you had cash in the streets, you'd get the blue rate. So now that we're back to CFK, they're back to this. Meanwhile, in Chile, very opposite political kind of place, more fascist than socialist. But, you know, they're not capital F fascist. They're not literally Mussolini. They're just fasci. They have a few, you know, they shoot a few people, whatever, now and then, you know, screw up the unions, not pay people their benefits, whatever. And so this currency is rather, I mean, it is at new highs, but it's only creaking about 15% weaker against the dollar since the highs from 2002. So that's not bad as a Latin American currency goes.
Right.
Yeah, right. I mean, like, look at all these charts. They're all racked.
Yeah, it could be
so
worse.
Chile's, yeah, and a lot of it has to do with the commodities being weak and the copper being weak, because it's copper export that fuels the dollar inflows to this country. So everybody became under this dollar system, basically commodity serfs to the Henry Kissinger world order, and Chile was like all about it. But it wasn't the fascism and breaking up strikes and all this that got Chile to be the economic miracle that it was lauded as. It was because they invented their own inflation index and their own banker currency called the Unidad de Fomento, UF. And you can actually pull this up on TradingView. You can look at a daily chart, and they'll quarter to quarter do an estimate of the inflation deflation. They'll kind of walk the dog up and down to recalibrate when they missed. And you can, and then sometimes it'll go way down in a deflationary event. I haven't checked it lately, but like in 2008, it went down 20%. But normally it works. So you can borrow money in this unit, you pay whatever the inflation rate is and that reindex every year plus 3%. You pay off your mortgage. You don't even notice the principal payment going up because you're paying less interest, right? So they do the math and it looks smooth. You feel like you're just paying the same amount, unless there's higher than anticipated inflation. So the thing is, expectation, they all converge. So from 1990, when they introduced it, they had 20%. By the end of the decade, it was 3-4%. Yeah, as Borat would say, great success. I mean, they couldn't defeat that genie until, right? So everybody would hoard dollars, and Ecuador would hoard dollars, and Bolivia, their central bank. I was speaking with their director of payments at a conference in Miami. He was a big Hugo guy, not Hugo Chavez. Sorry, my bad. It's a completely different guy. Evo. He was a big Evo fan, right? He like worked for Evo. And he didn't like Bitcoin. And they had like $10 billion or 11 billion in the bank, and their whole M0 base was effectively like 8 or 9 billion. So the Bolivian people were totally safe from any kind of Forex volatility, and they would give them e-money wallet. They're doing all the stuff that we Bitcoiners like to talk about, like banking the unbanked or whatever.
Yeah.
But they're like the socialist central bank, and then they just did it like with an SQL, and they like kick our ass on UX, and they got cash preference down from 68 to 38%. So the lesson in all of this is you can do it with commodities, you can do it with your own thing. And Bitcoin has to compete with that. So if you're small, like Bolivia, it doesn't really matter that much. It's like Tether or something, right? I mean, really, it's like the Bolivian economy's money supply is like 2 tethers right now.
Wow.
And then in Argentina's case, it's funny because you think, oh, Argentina's the socialist basket case. I've had a bunch of conversations with like Paraguayan immigrants who talk about just the deflationary vibe, just the lack of stuff going on, like just the sheer poverty of like living in Asunción versus Buenos Aires, where there's a much bigger economy. So it can kind of work. And then obviously there's Venezuela where people are starving and there's not enough medicine, and it's like almost a collapse. Anyway, so I don't want to get too into the weeds delving into Latin America. There's a whole lot of color about Latin America, but it's a great petri dish for lessons in dollarization.
Right.
So that may also have led me to be this dollarization guy.
Yeah.
Because I'm a gringo who went to Latin America to exploit the dollarization, right? Yeah.
I was much later to this topic, not having lived in Latin America, but maybe because it's like in some sense America's imperial backyard, or at least used to be. And the U.S. has intervened so many times in Latin America, or trade volumes with the U.S. are very high, but dollarization is very pronounced throughout Latin America, and there's so many experiments there.
Yeah, it's soft Monroe doctrine,
right?
Is what I was. Yeah. That's without all the IMF loans and whatnot. And then I was mentioning to you, there are theorists who delve into this more, but there's definitely like a very political tiering in the world insofar as who has access to swap. Oh, I think it might have been Tankus, Nathan Tankus, was talking about this. Just in time, just clicked. So you can see how like Nathan Tankus is like more interested in that side of it, but it's a thing, right? So it's the Cantillon effect, exacerbated.
Who has priority access to the Fed swap lines?
Right. And then, also irrespective of that, this is one for the right wingers, like Chile, by doing its own restraint and having a credible enough information flow between all these banks and so on to establish this inflation index, and then basing their banking system assets on that, they managed to earn legitimately, through trade surplus, a lot of dollars, right? So the Chilean corporate sector and public sector both have, instead of it like, the Politburo is stockpiling dollars for the people, like in Bolivia, they just earned it, through just good old capitalism. And in Argentina, part of the leftist politic is exacerbated by the inequality that's caused by the elite Argentines continually getting ahead of this game, right? Because it's not like, oh, as soon as Bernie gets elected, like people will always scheme, right? And it was the rich people who actually sort of benefited from the socialism because they could arbitrage more,
right?
Yeah, it was kind of sick. So what works, right? That's MMT in action over there in Argentina. And there's only so much soy income they can get. But at least soy, people are still feeding cows. All the supply chains are getting kerfuffled there. There's no negative beef prices yet. So Argentina's, it might work for them, and they reduced inequality a lot through all the aggressive money printing. So instead of lowering rates and getting everybody to bid up U.S. stocks like the Fed did, they like beat their currency to death every year. And everybody gets used to this double-digit inflation rate. And then it's a game of fudging how bad is it. But it never got so bad that small businesses couldn't just, keep marking stuff up every quarter or whatever. It's not like they're marking it up twice a day like my I knew a woman who grew up in Jujuy, and she lives in the hood in Argentina, and she got the apartment through Evita Perón's gifting sort of. It was like 2 months' salary to pay a fee, and you got it. And then she had that to hold on to in the next decade when she lived through the hyperinflation, right? And she'd have to go shopping twice a day, like before work and after work, because they kept changing the prices that badly. So in the modern era, technology has enabled enough. Well, actually, I don't know. I'm not sure if I want to comment too much on hyperinflation. It's crazy. I think what's more, I mean, it could happen, but what's more likely is this Argentine style kind of 70s pot boiler. And we're in the pot, right?
Yeah.
So
one of the main reasons I wanted to get you on here was, you've been an advocate for this theory of crypto dollarization, and you have a great blog post, which I'll link to, called HyperCryptoDollarization, which, to me is written partly as a response to the hyper Bitcoinization thesis,
yes.
Which, I don't know if that's a sincere thing or it's a meme or it's an attempt at Overton window opening, but it's certainly a concept which exists in Bitcoin land. And I want to read an extract because it's very sensible.
Oh, thank you.
And I quote, "The big story for cryptocurrency is not going to be hyper Bitcoinization. It's going to be hyper crypto dollarization. You can still see parabolic trend moves in the underlying collateral, blockchain securing commodity that is the base of the money supply expansion, but you need more functionality for people than just giving them digital gold. You need to give them a full reserve, decentralized banking system to turn that digital gold into digital currency. This creates a dynamic equilibrium price that satisfies all marginal demand for either speculative capital to bet on a rise in demand for savings capital or for the savings capital." And you wrote this in February 2018. Back then, we were kind of in the middle of this long bear market. Still are, I guess.
Well, it was just the beginning.
Yeah.
It was just.
Oh, yeah.
Just the
it was the beginning. That's right. So we were still coming down from that high in 2017. The interesting thing is stablecoins didn't really exist meaningfully in 2017. I mean, Tether grew, of course, but it was just like a tokenized IOU for Bitfinex's balance sheet. Nobody at that point had realized that stablecoins could have a transactional usage outside of just inter-exchange settlement. So I'm curious how and why you had this realization. How did you come to realize that this would be a significant theme?
Well, I was looking at my initial trades for some startup Chile guys in 2013 as a dollar transfer alternative, because you would pay like 1% to the bank to on the currency spread. It was something opaque that they could rip you off on, right? So I found a bank that would let me do it tighter. It was like a 1 peso spread, and it was like it was like a Java applet. And then once I loaded the applet, I'd have to call them and punch the ticket. It was cute, but it was efficient. So I found that. I cycled a little bit of that. So I was seeing myself as a dollar guy, because I wasn't trying to hold dozens of Bitcoin for the upside, because it was, I was too broke, right? I'm just trying to make money. I'm just trying to find a business, right? And then when I went back to Argentina, and I was talking with the Argentine guy based out of New York who does the dollar Greece bond trading, and I was like, let's do this with Bitfinex as the hedge. And it's like the same thing, but Bitcoin is the bond. And then I got involved with Omni, which was Mastercoin back then. I pinged Brock Pierce on LinkedIn, and he led me into the room, and it was a pretty good career move for me. It was like a well-funded, not super well-run, but a well-funded project in that time. And they were throwing money all over the place.
The first ICO. I remember a while back, yes. I was writing a thread trying to piece together the history, and you gave me lots of very useful historical context.
It's like 7 or 8 chapters of a book, like the multi-year arc. Maybe 5, depending on how. But yeah, there's a lot of story just in what happened with Omni Layer Foundation, 2014 and 15. But ICOs maybe have moral hazard, and that people are less likely to be judicious about spending.
Right.
And then also they weren't hedging. They were not dollarizing themselves. So they had a weird treasury policy that was sort of a lack of a treasury policy. But it made a certain weird sense from a tax point of view, where they would just pay people out in Bitcoin. And the idea is you're realizing gains as you deduct the total. So you don't have to worry about dealing with capital gains tax. But then they missed the chance to sell their treasury at 1K or at 650 and so on, which led to them being underfunded. Then there was a famous bait and switch that I undid a year later. And then Craig and I were like bros, and I was like, hey, there's going to be these derivative coins, but I think also there's room for USD receipts that are like exchange liabilities, because obviously that's a thing. And I think Bitfinex is a likely innovator to take that. This was when Bitfinex was like the white knight before they became the rogues gallery, right? And this is how they became the rogues gallery is, okay, great. They're innovative. They adopt Tether. I went out on a trip to Hong Kong in 2014. I met Jean-Louis Vanderveld. It's a very classy name. I was very impressed by meeting him, because he like lives up to that name. You know, when you meet him, he's got like a good hair, like a little coif and like a sweater and everything. And then I met Arthur and Ben downstairs at the bubble tea shop, and we were talking about their thing, and they were talking about how, you know, we're the central counterparty. And I said, bro, I didn't say bro at the time because I didn't adopt that nomenclature back then. I've been infected since, but rather I said, you know, look, what you got to do is give people this one-click experience to just get this dollarized yield. And they like, they didn't like really go for it at the time. They thought it was more about the speculators and the spreads, which was Arthur's background, right? So Arthur was an ARB guy at Deutsche, and that's how he does his writing, and it helped. It really worked. He like taught people, like, you can buy a Bitcoin and you can sell this, and you get the cash carry, right? Like, he popularized that. But it took them, there was like a time lag. And in that time lag, there was the bear market. I was super broke. I didn't get the funding that I was going to get. Then I was looking at, so this is something I haven't mentioned on a podcast. There was this moment where I was looking at the accounting for the ICO's coin addresses. And the word on the street,
which ICO?
For Omni,
okay,
for Mastercoin.
Yeah.
And the word on the street was that, you know, the money was all gone. This was like January 2015. And then I did a little forensic accounting on the blockchain, and I saw like there's 1,000 Bitcoins on this fourth address. Like, what the fuck, right? And then and I was like really freaking out. I was like, what is going on? Like, are JR and DJ like pulling one over on me or what? And I asked him about it, and JR's like, oh yeah, one of our trustees gave us other Bitcoin and to hold that in cold. And I was like, okay, sure, that makes sense, right? These are fungible, whatever. This is the thing with trustees as well, right? This shit has to be documented. So another like 9 months later, after doing things on no budget and like kind of joining the board and proposing how we spend the dev reward, which was this extra Omni that was left over, and then taking delivery of a bunch of coins and starting to post a lot of orders to try and improve the liquidity in it. Then I looked into the accounting, and I found, you know, basically there was like a self-dealing transaction at a very bad price, and the tax code was like punitive towards it. So I managed to like ring that bucket. So then I was the treasurer, and I stuck to basically like a 30 to 20% long exposure of under hedging, sometimes 50, which I thought was pretty good. But then, you know, it was like, what if we didn't have you managing the money and we just got the total return of Bitcoin like before, right? So they like got their treasury wrecked by not hedging, and then I underperformed by hedging, but that's life.
Because the hedging period was 2013.
No, the non-hedge period was 2014.
Okay.
And then the period hence was a lot less money than they originally realized as well. So that was a part of it. Otherwise, I would have you know, I could have punted on a long, on a big long on Factum and stuff. I just didn't want to, you know, I could have taken one on ETH. I was like, ETH's not my project. I'm gonna, you know. So anyway, so one thing about me as a money manager is I don't take that much risk, which is why I'm obsessed with this stuff. If I take more risk, I'd have maybe made more money. But when you're a fiduciary and you're doing payroll, right? Or if you're like a single mom and you got to buy Huggies, you know, you can't take those time horizons.
Yeah.
And this is why we need this. And at the time, so Dan Larimer had kind of kicked forward the idea in his blog posts about BitUSD.
Yep.
And basically BitUSD, so like all dollars, it's like a sort of abstract accounting brand, you might say, based on essentially redeemable liabilities, right? So in the US's case, it's redeemable against this liability that they're generating all the time, which is anytime someone makes money in the US economy, they owe tax. And you've discussed this at length in other podcasts, you know, the Fed, the military, everything, right? Great. So we understand that this is kind of unfair. And then, and there's a lot of the financialization since the 80s has been driven by a shift from secured lending in business or sort of loose, lightly unsecured lending in business, like commercial paper going back to like the 1880s, right? But then you got into the retail, right, in the 70s and really in the 80s with the Kissinger petrodollar and the growing money supply with less inflation. I showed a chart of that to a bunch of Latin American bankers to explain, like, this is why your career has been different than this, you know? This is what it was like to work at Citibank. You guys were doing something else, you know? And so the US created this Goldilocks situation for themselves, and you could just expand. But anyway, we're going back. So like Dan Larimer's point was, let's go back to secured. We can create a dollar as a secured loan against these bit shares, but with it was like a very low loan to value ratio.
Right.
And I met a guy in the Bitcoin embassy in Buenos Aires in early 2015 who was working on a dollar wallet for BitUSD. So, you know, they were trying to get the last mile part in place. But I think a big part of the reason why that didn't take off is timing with the cycle, right? So that was a child of that 2013 cycle. And by 2017, we were on to basically BitUSD 2.0 with Maker and some of these other ETH-based fancier.
I mean, Maker is like very similar to BitUSD, right?
Pretty much. It has a more generous loan to value ratio. And to be fair, the underlying asset is like, you know, 100 times bigger market cap than BitUSD.
That helps. That helps. As opposed to BitShares being the collateral. Yeah.
Well, yeah, because all these models, and mine included, right, full disclosure, rely on there being demand and Bitcoin. Like if you did a full simplicity mass, whatever, to do it all in Bitcoin, it all, you know, and the security model Bitcoin, all of this stuff relies on there being demand. Now, fortunately, so like the problem with BitUSD or like Nubits, in BitUSD's case, BitShares was a proof of stake. So there's no seigniorage. It was all fee shuffling. And, you know, it works as well as it works, but how well does it scale? Could a state actor knock it over if it were worth 10 billion, right? So this never, I mean, now this question's up with Ethereum, which has belayed the question by 6 years because it's a really scary question. But that's a separate thing. And then Nubits was what was hot. So I was going to start market making in Tether on Poloniex. And the word from Tristan, the CEO, via Craig, was that like we really need to like get this up because they want to like delist Tether and list Nubits.
Really?
Instead,
when was that?
This was March 2015.
What was their preference for Nubits over Tether?
It was just doing like 90 Bitcoins a day, which back then was not a whole lot of money either. It's like 100 grand, right? But like, but yeah, basically just because it was doing more volume. So they needed a market maker to like kick it up. But the reason why Tether succeeded and the reason why like also Tradelayer is built on Omni still, and why I want to do the same thing with this decentralized successor, hopefully, is it was really easy to install, right? You just spin up a Bitcoin node, you're already running it, you've already got the blockchain and your DAT files on your local. Maybe don't, you know, point two instances to the same folder or whatever if there's any. that might have some edge cases. But yeah, I mean, it's simple enough to install, right? It's just an alternative Bitcoin node.
Omni, that is, right?
Well, and Tradelayer.
Oh, yeah.
Well, and for Litecoin, and then we got the Bitcoin port. Yeah, so it's the same idea. The whole idea with op return is, instead of designing particular op codes and then trying to get through the hard fork process, or trying to do user activated soft forks, but then how reliable is the counterparty risk there if it happens to be a miner who mines your transaction, like somebody exit scams you in violation of the op code.
Yeah.
Right. It's most miners are gonna mine it right vis-a-vis the USAF, but then Jihan can get you or whatever, right? He could even be your counterparty, and then you get exit scams, like that. So it's not the most, as far as like, I'm a financial institution, I want to like plug into a TSR with Goldman, who's going through State Street, who's going through ICE, who's plugging into this liquidity complex, so I can get, whatever it's going to be, 7% a year in USD or something like that, as these things mature. Right now they're a lot higher, but that's just because it's a small speculators market. I mean, I'm not going to speculate about rates, but the point is, it needs to be like that, and every layer of the stack from which that yield springs, because obviously it's driven by the decentralization, the demand for the bearer collateral in the underlying. So there's performance in the underlying, so that the punters can pay swap to the savers and still come out ahead. Otherwise, they go broke and the rates go away, right? So what I'm trying to say is, it's harder with Bitcoin. So with op return, you can just say, okay, we're going to design a TX, we're going to put in a payload, we're going to parse that. Here's C++ logic. We infer changes to a data structure. We hash that so that nodes can make sure they're running the same state of reality together. And then we can use the Bitcoin ledger rather freely. So this was like a really early way of trying to add Ethereum-like functionality, like tokens, or like dividend payouts or whatever.
That was
to Bitcoin.
That was the whole premise of Mastercoin.
Yes, and it even had a Nubits-like pegged currency feature and a derivative-like bet feature. But the derivative bets were all very bespoke OTC, and then of course the pegged currency is Nubits. It's not gonna work. You can't just wish away units and have it. Like, that was like basis, right?
Yeah.
So basis is a funny word, because what actually does work is derivatives, and derivatives have basis, right? They have some difference between where you trade it and what the underlying reference is that gives it value. Therefore, there's time value. So it's an alternative to paying interest. And if your counterparty, if you are fully collateralized in your 1x short, your counterparty may well not be, and even if they have the one Bitcoin for the one Bitcoin notional, they'll still get wrecked at a 50%, right? That's how the inverse quoting works. So there is no, full reserve, capital F, capital R, but you, the hedger, are fully reserved and therefore can never get liquidated. So your Bitcoin at $1 million would still be the same $10,000 you hedged today plus whatever you got paid, but the Bitcoin underneath of it would be much less, right? But it's still wealth, and it's that stability in the basis that on which the whole thing hinges.
So you were around as some of these really early stablecoin ideas were being kicked around, and then it's interesting that like 6 or 7 years later they're being replicated on new blockchains with slightly different tweaks in new contexts. Like Omni has, or Tether has just for the most part migrated fully to Ethereum now. We see BitUSD in MakerDAI, Nubits, those ideas were reincarnated in Basis, which is now in other projects like Terra and Celo. Which of these models for stablecoins do you, and there's new ones, like you have your idea about swaps or derivatives is now being popularized by the value folks who are using hedging on Bitfinex, or on BitMEX to create dollar exposure with Bitcoin. So It's clear that that's your preferred method, but I'm curious as to how you break down the relative advantages.
Well, I mean, just like use an analogy of you got like Hong Kong and Saudi Arabia, and they've had dollar pegs that have endured, or like UAE, right?
Yeah.
Their dollar pegs have endured with like no volatility, right? Like if you could sell options on them, how would you price them? Right? I mean, there'd be something, and that would be like this CDS like yield on the sovereign, basically, right? That's how you price them. So that's because they just like have enough money, right? So then you've got things like what Argentina did in the 90s, where they did it kind of fractional reserve, and then that broke. I remember listening to your last guest talk about that, so I won't delve too deeply. So I think that the derivatives model, like what happened in the 80s, is that banks started creating dollars notionally as M3 essentially between each other, and you got this huge web of like hundreds of trillions by the 2000s. By the financial crisis time to come around, of interest rate swaps to manage your risk of rolling over debts. And of course, everybody's got a lot of debt in this era, so it's a popular product. And then, the open interest is because they don't net neatly, right? So like net notional might be a lot lower, right? And Dodd-Frank has helped with that, and that's led to more sucking sound. Because what happens is when so imagine if this Bitcoin thing caught on. This might be illustrative, right? And we created a global financial crisis because everybody was trusting in, my idea of a decentralized dollar, right? What would happen is you might have, Bitcoin at N trillion, and a fraction of that is in money float. And then a derivative open interest might be like approaching Bitcoin's market cap, or bigger, maybe like 50. So the nice thing about Bitcoin is it can't become 200x bigger, because that's just very easy to knock into deleveraging with any real volatility, which Bitcoin is also great for. But like, for instance, I could be clever Chad, long a bunch of futures and short a bunch of swaps, and I have this big balance sheet, right? So my actual capital, I'm just sort of taking a little bit of risk to earn time value with leverage. And it seems safe enough per my VAR model. Okay. So like I do this stuff today, right? So if people like me with a lot more capital were doing this at a bigger scale, and then they started to unwind because the basis got crushed, right? The futures came down, the swap's not paying anymore. It's time to unwind this trade, dump the coin, go back into a 0% interest base, or what, maybe fiats will be negative at that time, right? So that doesn't exist anymore, and that's interesting. But theoretically it does, right? So yeah, that system could have problems, right? And because it's inverse quoted, the hedgers are like holding a ton of coin, and then so the spot selling can even go, it can go on proportionally to the downside until there's got to be something, right? So in Bitcoin's case, it's that you believe in the ledger, and this is like the best monetary game in town, and the scarcity, right? Really, the scarcity is last. The scarcity is definitely important, but I'm not like a stock to flow alkalite as much. But okay, sure. We all buy it because we like that at some level. And then, if it's something like our Metacoin, it doesn't have the base, right? So it needs the cash flow from the oracles. So the oracles are kind of like the external reference. And if there's commerce there, then there's sort of cash flow for the nation of Total, or the nation of ALL, on Bitcoin and Litecoin respectively. So without that kind of inflow, and without a proper pricing of the time value of money, all of these models, which are sort of loan models, they don't work. And the whole problem with the legacy system is the politicization of the price discovery of time value of money, right? It's sort of a big propaganda play that we're in with that, hence WeWork, et cetera. So by retaking that, not only do we create better information from just sort of like a Hayek point of view, but from like a populist sort of Proudhon, let's open, money to everybody and have a more egalitarian society. It's egalitarian in the sense that a poor man can access a lot of capital at leverage and like get margin called, or maybe do really well, right? And that's something that we haven't really had in humanity, is that completely like anyone has a phone, and now you can put up $10 and borrow technically 1,000 notional. That's risky, but it's there today on centralized exchanges, right?
Yeah.
So then there's caveats with those, but when you can factor out the custodial risk entirely, and then you have, of course, your operational risk. You shoot yourself in the foot not managing your keys, right? So we have to solve that. And I think trustees will play a role, because most people can't do that, right? To get this to be, institutions don't want to mess with it on one side, and like grandma can't have, she doesn't want to hassle it either, right? So I'm hoping to move towards that UX so that everybody in the world can just have dollars. I'm not saying everybody should go into it. I've studied Myron Scholes a lot. He really screwed up. People get over enthusiastic about financial models, and they get popular, and you become like a celebrity, whatever. You go hang out with Nouriel Roubini and drink cocktails and like make women nervous together or whatever. But right, that was your theory, was that or wait, was that my theory, that he was afraid of Me Too, and that's why he's engaging with all the crypto Twitter guys?
Nouriel,
that right?
Plausible, I guess. Yeah. So
yeah.
So given that you expect dollarization to accelerate, I mean, we've seen Argentina looks like they're going to default. I think that was actually announced today. What effect do you see that having geopolitically, in particular in LatAm?
So I think, it's sovereign debt's kind of an interesting edge case, because the bigger story is the stealth defaulting through like the long-term boiling of either inflation. If they can get it, they can't get it in the developing countries, or they create a sort of artificially suppressed real yield in the asset base, which makes leverage more profitable and so on. So it's like zombie corporations in Japan, but for the developing countries' banking systems, right? So meanwhile, in countries like Argentina, obviously, if you're a bank in Argentina, you can't lend. It's really hard to build up an M2 with that. You have to lend at ridiculous interest rates to make it a positive real yield for you. And so they depend on dollarization so under Macri, it was like legal to you could just openly do it instead of this dance. So yeah, I mean, it's sad to see, I spent enough time in Argentina. I'd like for Argentina to move forward. When they went neoliberal, everybody hated Macri because their gas bill went up, and that's what they see.
Right.
So there's like not everybody's like us, right? Like, and it's actually, it's just MMT in action. And if they default, that's just them holding on to more dollars, basically. So I think it's a great scam for them. They managed to sell a 100-year bond. That's completely unbelievable. I'm hoping that the U.S. Treasury manages to pull off a 50 so they can do the same scam. And then we'll be really cooking. But I don't think it's likely, obviously, speaking seriously, developed countries don't do business that way, right? But yeah, it'll shake up. I mean, the Argentine currency has always been inflationary, right? Yeah. So Argentine people are not going to become more dollarization oriented than they already are, except perhaps that lower income people will start to buy dollars because they can afford to if there's enough economic growth, right? So that's the thing that's kind of the sad subtext to this, is that dollarization won't save everybody. It only saves the sort of bourgeoisie people who's socking under the mattress, right?
And it's always to the benefit of the first movers who can get out before the local currency depreciates even more.
Well, like those guys who robbed me were sort of beneficiaries of a political posture that is like very sympathetic to them more than it is sympathetic to me, right? And they may have been, certainly secondarily the beneficiary of subsidies, and maybe directly, or like their mom or whatever, because they were like 20, these kids. You live with your mom, but you have a gun, so you can like rob people. I get it.
So I'd say that like the really big story of 2020 so far has just been the like eye-watering growth of Tether. Tether is very controversial and so on. It seems to be getting usage, just from what I've heard anecdotally, not just for crypto purposes, but just for B2B payments, remittances, etc. In particular in Southeast Asia. The monetary base is over 7 billion now, which is kind of monstrous. What do you make of its long-term prospects in terms of resiliency and its ability, A, for the currency board model to work, or B, to resist, the NYAG and rogue governments?
Okay, so we're just talking about Tether. I mean, yeah, the Tether's problem has always been AML, right? They took on BTCE's balance sheet in 2017 and effectively irradiated themselves forever with, Bulgarian dollar and, offshore money maybe in Bulgarian banks that couldn't be moved. I suspect that because they have access to a webbing of counterparty relationships, order books, open interest books, hedge books, and the like, right? In Bitfinex originally, and now throughout the wider Tether Federation, that Tether's assets are largely made up of basically dollarized crypto, and with some degree of rehypothecation, which is expressed in beneficial borrowing relationships that traders can use in combination with lower tiered fees to either arbitrage micro opportunities or throw around 100, 200 Bitcoin orders on Binance to try and move the derivatives around through short-term market impact. It's very sad. I basically see it as an alternative to the BitMEX swap, where you have a similar ratio between the actual amount of Bitcoin and the on deposit and the order book and the total volume, and open interest is somewhat larger, right? Not everybody who is short a swap on BitMEX is fully collateralized, right?
Yeah.
So it's this Wild West kind of thing. I think the United States, though, instead of coming at this like, oh, you ruffians, the United States has got to step up in its game, and so we've gotten some things approved. We've got the infrastructure. Wall Street hasn't quite jumped at it. So I think since we're coming up on our time here, like the essay that you're trying to weave here is the narrative and the history of this story, right? And so I was going to talk a little bit about USDC and whitelist versus blacklist and travel rule. I think I'm going to like logjam that. Basically, like I think FDIFT is going to put down more constraints, but things like USDC can certainly adapt to that. Tradelayer supports whitelist. You can also do it P2P. Real businesses are probably going to prefer not to go through a third-party KYC group and just P2P. So we're going to have this white trading zone where addresses that have more metadata on them, and therefore it's easier to enforce the travel rule and other tracking, are going to probably be segregated from all the guys who are off doing CoinJoin and who are using Taproot. And so they're both going to exist, right? And we're going to onboard a lot more capital that doesn't really care about being Bitcoin denominated, but it uses the Bitcoin. It soaks up the spot supply. And we need that engine to catalytically move the market higher, which creates a positive feedback loop in scarcity of the spot market and having a positive sloping derivative structure so that people can have these dollar positions and get paid. Then it's like, well, why don't I do that? Once institutions and then regular people appreciate this trade, and then the clever people will borrow or they'll short things. And so they'll be like short one funding rate and earning this other funding rate. Like there's a lot of ways to speculatively attack this positive real yield as long as it persists. So the real constraints are the number of people long and obviously net inflows and fiat like fueling that, right? Because obviously once there's that little trickle and it starts to really move, then more speculators will lever more and so on. And my thing is to not let the little guy get fallen behind in all of this, but to try to encourage the so-called little guy to trade or to save, depending on what their personal profile is. Trade, trend follow, not necessarily day trade. People can't make it like that. But use the leverage to participate in the secular shift and this global debt jubilee that's implied by Bitcoin getting repriced into the 6 and 7 figures. And I'm trying to fuel that.
So, Patrick, this has been a really interesting journey through the origins of stablecoins all the way through to where they are today. And you've had a front row seat of that pretty much the whole time. I'll definitely post your HyperCryptoDollarization piece, which at some point may be considered seminal. Where would you recommend people follow you? How should they follow your work?
Well, you can follow me as Duganist on Twitter @Duganist, and I'm a bit colorful, a bit zany. I like to talk about physics and game design and other things, and really minute trading stuff. It might be over people's heads, but I'd love it if you would all go follow Tradelayer, because we're getting ready to launch our beta for real this time, and so it'd be good to port some of my audience over there and get some new followers
On Twitter.
Tradelayer, yeah, @Tradelayer. So that'll all just be clean updates.
Okay.
Nothing off color. Yeah.
Great. Well, I'll post the links. Thanks so much for coming on, man. It's been a pleasure.
I really appreciate you having me on.